Thanks for joining me, Brock. I know you were with Preferred Trust Company, and I wanted to do this because we're sending this out to people who do have IRAs, and we're starting our campaign to be able to talk to them. And a few people have already asked me questions, and we've been working with you guys for a while. But I wanted to do this because it's new and just kind of have something fresh to share with people. So thanks, man.
Yeah, absolutely. And thank you for having me here, Victor. We're really excited to be on this call with you, share some insights on self-directed IRA investing, and hopefully answer some of those questions that your clients have been having for a little while now.
Perfect, perfect, man. Well, first, and we'll just jump right in it. So, because that's typically what people like. A little bit about like what you guys do, how the company's structured, and how you help people, and then we'll get in kind of like this first thing because I got questions that I wanted to kind of hear from you guys as well to help.
Yeah,
So, yeah.
absolutely. So, I mean, a little bit about us, a preferred trust company. We're a full service self-directed IRA custodian. And
Uh-huh.
if you're not sure what that is, think about how, you may have heard of other big companies that deal with IRAs and hold your funds there. We do the same thing, just in investments outside of the stock market,
Oh,
right? So
yeah.
real estate, precious metals, oil and gas, list goes on for other types of investments. And I think one of the ones we want to hone in today in is real estate, especially
Yeah.
inside of a self-directed IRA
Right,
investment
right.
there. But what we do is we make sure that your IRA funds are compliant with the IRS. We make sure your investments are compliant with the IRS. All the reporting is done for you because the IRS wants to know where your money's going, and we make sure that's taken care of. And then on your end, we provide absolutely seamless service. We
Yeah.
answer the phones. If we happen to all be on the phone, you're going to hear from us in less than 24 hours as a response back to answer any questions or just walk you through any processes of how we can best service your account.
Perfect, perfect. And I appreciate that. And that's true because every time I've ever called, someone calls me back. You guys are super responsive. We've tried to work with other companies in the past, and it takes an act of Congress. So I appreciate you guys are always kind of doing that. How much, because I know it's called something different. Typically in real estate, it's assets under managed. How much was it like under custody or something under custodial? Like how much capital
Yeah,
do you guys
assets
do?
under custody is,
Yeah,
is is
yeah,
what
yeah.
it's referred
Assets
to
under
over
custody.
here.
Yeah.
Yeah, and so currently assets under custody, we are sitting approximately around the $600 million range in
Nice,
assets
nice.
under custody.
Mhm.
I don't have an exact number off the top of my head, so don't quote me on that
Yeah, no,
saying
it's
it's the
okay. It's all
exact
right.
figure, but
That's
but it's
good.
around that number or so.
Good, good, good. Well, it's good to know that, right? Because people are like wondering, and I know like at some point, just lifetime of the company, there's different levels of those things. People trade in and they trade out and stuff like that. So it's good to know that you guys have assets under custody or you have had, this massive amounts anyway. So you're not like new guys. I know you guys, the company has been around for a long time. So
Yeah,
yeah, for sure.
absolutely.
For sure. Well, good. So that helps me, and that's gonna help anybody listening too. So I wanted to kind of jump into it because I talk about this a lot in some of my presentations, and I talk about like, and we've all heard it, right? Like IRAs and 401ks at some point, whether it's real or not. I want to do a quick myth buster. Like we're kind of set up for the institutions in the big in Wall Street. I've seen that quite a bit. Like we hear it all the time. What is your take on that? And like, what are you finding is the real truth about how the system works and how some people should be able to control their retirement accounts as well?
Yeah, I think that's a phenomenal question and a great myth buster to start us off with, because
Yeah.
I'm pretty sure everyone in the retirement industry has that on their mind. That's all you hear about, these big
Yeah.
institutions, right? How these institutions are handling their money, how all these
Mhm.
institutions are basically handling your money
Right,
and
right.
everything too. And so we have this viewpoint that, it's all about the institutions on there.
Mhm.
And I'm not going to sugarcoat stuff. The institution does benefit. So does the actual, usually the investment company itself,
Right.
but also the individual does have benefits on there. And I think the biggest reason we always hear about the institution is just because it's on a larger scale,
Right.
right? It's on such a large scale of these money and pools of capital and everything that we hear about it more because it affects more movement across the entire society,
Right.
right?
Right.
But I'm going to break down a little bit on kind of how each one does benefit in
Okay.
that process.
Yeah.
So you
Yeah.
have the financial institutions, right? And of course, they're managing this money and likely they charge some sort of fee associated with an account. If you ever had a bank and your bank account had some sort of fee associated with it, that's what I'm
Yeah.
talking about,
Right.
right?
Right.
That's how they're making their money and pulling it in. And that's really where they're going to get their benefits in from.
Right.
When
Right.
we talk about retirement accounts, we're also going to probably go into a little bit of employer sponsored
Right.
retirement accounts, which are like
Mhm.
401ks and things like that. So the
Mhm.
employer is benefiting from these retirement accounts as well. They
Right.
can have lucrative packages for their employees. Maybe
Mhm.
there's some tax write-offs on their contributions and things for the company as well. But I think the most benefit, as much as we see it with the institutions, I
Yeah.
really think it comes down to the individual investor still. We're
Right.
just not seeing it through that lens.
Yeah.
Right. And essentially, through these retirement accounts, you have the opportunity to have a tax sheltered environment,
Mhm.
right? Through the traditional or Roth. We could break that down in a little bit, on how the tax benefits work on each one.
Okay.
And you have the ability to compound your growth inside of this tax sheltered environment. And I
Mhm.
think when you take those two tools and put them together and utilize them correctly, it could be a very lucrative and effective tool in terms of building your wealth and planning for retirement, even more so on the individual side than I think
Right.
the corporations can ever have with it.
Yeah, yeah. And that's a great explanation of that. So thanks for that. Because, I share with people all the time. It's like you should be able to control your environment if you have the opportunity to do that. A lot of people, which, I assume a lot of people know and a lot of them don't. Ironically, right? Just because of the information age in the past, maybe you had to have somebody educate you on that. But now I feel like more people are aware of it. They just don't know exactly what to do and how to do it. So thanks for that.
Yeah,
Um,
it's like having all this knowledge but not knowing where to center it in on. And
Yeah, yeah, exactly. And that's why I wanted to do this with you. So thanks for that. So let's see. Next question I had on here was how do people know? Because I have people like we talk to them like, hey, if you're interested in talking about being able to invest or convert to a self-directed IRA, like contact us and maybe find out so that way we can find out if you have a qualified, account. So how would people know if they have a qualified account? What makes something qualified to do that?
yeah, great question. Absolutely. So qualified account is really going to, let's break another term out of that.
Yeah.
Qualified funds is another one you'll hear a
Perfect.
lot too. And qualified funds really just essentially accounts for any sort of retirement funds, whether it's in an IRA, right? This could be your standard IRAs like you might see with bigger companies like Fidelity and Schwab and things like that you're investing in the stock market.
Hmm.
Any IRA like that. It could be a self-directed IRA with a company like us, a preferred trust or another custodian,
Okay.
or an employer-sponsored plan. Right.
Mm.
A lot of times, where most people's retirement benefits lie is you work for a company, you have a contribution to your 401k plan, or might be called a 403b if you're a teacher, or different
Right.
fields have a couple different names for it. But
Right.
where you pay into this retirement plan that you can't touch until
Right.
retirement,
Yeah.
and your employer pays usually will match some sort of pay into it as well. Now, if you don't know, you just like, I just have accounts, I'm not sure what these are. A couple
Right.
good places to always fall back to and check your account statements, right?
Mm. Yeah.
Chances are it's called that 401k or IRA traditional or IRA Roth. You're going to
Mm.
see these phrases on the actual statement itself. But then when you're asking, well, which ones can I roll into a self-directed IRA, right?
Yeah.
If I have
Exactly.
an account, I now how which ones can I roll into there? So on that point, really you're looking at any IRA
Hmm.
is going to be viable, whether it's a self-directed IRA or just an IRA you're investing in the stock market with or anything like that. Those are all
Okay.
viable. Or an employer-sponsored plan, and here's the kicker, that is from an old employer of
Mm.
yours. If it is a current one, if you're working at a company and you're currently contributing to your 401k plan, chances are there's some pretty tight regulations around that 401k plan. You're not really going to be able to do anything like move funds out of it or transfer them around
Yeah.
until you're no longer working with the company. And so usually it's an old 401k. If you want to see if your current 401k plan can do it, the best place to start is to go talk to the company that's
Mm.
administering your 401k, and they'll let you know all the rules and regulations around it.
Right. And they're typically working with like a Fidelity or Vanguard or something like that.
Yeah.
Yeah. Okay.
Yeah, and, and, and
BlackRock.
anyone like a yeah, and anyone like those, chances are they're going to be able to transfer through as long as it's not a current employer.
Got it. Got it. So you got to either that's an old account, it's an old 401k or something like that, or quit your job.
Yeah, and yeah, Dad, yeah, or quit your job. Yeah, but I'm gonna add a note on to that. If you
Yeah.
have an old 401k, right? The way that these plans work is they're mostly set in plan to benefit you and
Uh-huh.
benefit the employer as long as you're working there.
Right,
As
right.
soon as you're no longer working there, a lot of those benefits the employer gets from there are gone, right?
Mm.
And so what ends up happening is most old 401ks are sitting there, they're not earning any interest. And
Mhm.
the company that's holding it, they get to make money off of your money. So why wouldn't you make money
Ah,
off of your own money, you
right.
know?
And thanks for sharing that. That's vital. So a lot of people don't know that. So like, I mean, if you do have a 401k, you're not there no more. The money's just sitting there. A lot of times people think it's still growing. So that, man, that's probably one of the more bigger pieces that anybody can take away from listening to this. So if they think their money is growing and they just have it there and they're like, I have this money, it's probably not doing anything whatsoever.
Yeah,
And they probably won't
absolutely.
touch it because they're afraid to get penalized.
Yeah, or just don't know what to do with it, right? It's just the
Yeah,
world of
yeah.
unknown around it.
Mm.
And so absolutely get your money working for you.
Perfect. Perfect. Why? Thank you. That's vital. That's important. Um, let's see. Another thing I wanted to ask, like, what is it like? Typically, somebody's like, "Hey, am I going to be penalized for converting it?" Like, and I know that, but I wanted to kind of go through that. Is there penalties to take your qualified plan or qualified funds and then convert it to an self-directed IRA so you could invest in real estate?
Great question. And the answer I'm going to lead with this, and I'll kind of explain a little bit, is no. There really
Mm.
aren't any penalties as long as you're going from qualified funds in a qualified plan to qualified funds in a qualified plan. As long as you're
Right.
making that same shift, there really aren't any penalties. If you're moving them from a qualified plan outside of there, then they're probably going to look at penalties and stuff. But the
Got it.
only time you really need to worry about, and I won't say penalties, right? I'm going to change the word from penalties to taxes,
Okay.
right? Because a lot of times what we see
Mm.
as penalties from the IRS is just us triggering some sort of event that requires us to pay a tax on it,
Okay.
right?
Right.
And so if you are going from a traditional IRA setup to a
Mhm.
traditional self-directed IRA, you won't have
Uh-huh.
any sort of taxes with that. If you're
Okay.
going from a Roth IRA setup to a Roth self-directed IRA, you won't have any taxes with that. However,
Mm.
important to know, if you are going from traditional to Roth at that point, that is called a Roth conversion. There
Mm.
are taxes associated with that. So it's only if you're going from traditional IRA and moving that to a Roth IRA. That's
Okay.
where you'll have some sort of tax interaction. And I wouldn't be able to tell you exactly the taxes you'd pay. You'd need to consult with a tax advisor for that.
Right. Right.
But generally speaking, qualified plans, qualified funds, traditional to traditional or Roth to Roth, you're not going to have any sort of taxes or fees along with that.
Okay.
Maybe a wiring fee, depending on where you're
Yeah.
transferring your funds out of. They might charge you a fee to wire or write a check, but that's it.
Okay. All right. So basically stick to a like kind plan, Roth to
Exactly.
Roth.
And no
Yeah,
fees.
traditional to traditional. That makes sense. Good. You know what? And that's perfect because, some of the investors that we're talking to that do have that, when I'm talking to them, it's a lot easier to the simplification of as long as you're staying like kind to like kind, just like
Yeah.
any other investment, if you're trading up and not getting taxed, that's what you want to see you stay in the lane, right? That's what I say, stay in
Yeah.
the lane.
And I want to add one more quick clarification note.
Yeah, of
Whether it's preferred trust or a different custodian out there, I can't speak to others' processes, right?
course.
But there typically are fees to set up the account
Yeah,
with the
yeah,
new custodian and
right.
to transfer the funds in. So, like, I
Mhm.
want to make sure I clear that up. That make sure you're talking to the custodian. There might be some fees associated with transferring your funds over, but there's no like penalties from the IRS or anything
Right.
like that for moving
Yeah. And
them.
those fees are super minimal. Like,
Absolutely, they
yeah, they're
are.
super minimal in exchange for what you're actually achieving with your plan and your funding.
Hmm.
So it just makes sense for you people to pay that and be able to self-control, self-direct. So yeah, great. I talk about we'll stick in this one because this one is about the UBIT tax. This is something that somebody was asking me about. They were asking me about it, so I definitely wanted to ask you to address it. Some people have this thing, but if you can explain what that is and how it could affect somebody, that would be great. I appreciate it.
I'll preface it with that's a loaded question.
It
And
is. It is.
you talk to anyone in the self-directed IRA world, and the one topic they usually want to avoid is UBIT, just because it is one of those things that that breaks down into kind of the more I'll call it advanced side of
Yeah.
of IRA and retirement accounts there.
Yeah.
So
And you
what
can keep it high
UBIT is,
level. You can keep it how you
Yeah,
want.
yeah.
Yeah.
And what UBIT is, right, is unrelated business income tax.
Mm.
And you'll also hear another kind of I'll call it acronym thrown around, which is UBTI, which
Okay.
is
Yeah.
unrelated business taxable income. So
Right.
you'll
Yeah,
hear them
exactly. Those
interchange. One
two.
is the income, one is the tax you get on the income. And
Hmm.
essentially what it is, your IRA is set up in a tax sheltered environment, right?
Right.
Whether that's Roth or traditional. And on that end, there's still some things that can happen within your self-directed IRA because we're outside of the stock market and going more into private investments in the alternative world.
Right.
There's some things that could happen that kind of would border along the lines of possibly avoiding paying taxes,
Hmm.
and they essentially trigger what would be called UBIT, the tax inside your IRA. And let me break that down.
Yeah.
So the biggest two examples you'll hear about are pass-through entities like LLCs,
Hmm.
right? Things like that are passing the tax from the company to the owner or the investor, or debt financing,
Right.
like in real estate, is another big one on there. And just a quick example, because there's a lot to this topic, and the
Yeah.
best thing you can do is talk to a tax professional
Exactly.
about UBIT,
Exactly.
which we are not. But essentially, thinking about a pass-through entity, think about if your IRA owned 10% of an operating business. For fun,
Hmm.
let's say it's a lemonade stand,
Right.
right?
Okay. All right.
Let's say
Yeah.
you own 10% of this lemonade stand, and let's say the lemonade stand that year does $10,000 in profit, which great lemonade stand.
Right. Exactly.
But
You're
this
crushing it.
$10,000 in profit, your 10% share, your IRA was responsible for $1,000 of that
Hmm.
profit, 10% of the 10,000 on there.
Right.
Well, the lemonade stand is a business.
Yes.
It's generating business income,
Hmm.
right? So the IRS says that should be taxed as a business.
Right.
Now, since it's an LLC, instead of taxing to the business, it usually passes on to the owner or the investor, in this case, your IRA.
Hmm.
But since it's an IRA, it's tax sheltered.
Right. Yeah.
So if we were just go by those rules, we now have this tax-free channel for this business to earn income and not pay taxes. And
Right.
the IRS says, "Well, hold on, we can't do that."
Yeah.
And
Yeah.
so that's why you'll get charged the UBIT tax, which is going to be based off your portion of that $1,000. You're not going to be taxed on 10,000. You're going to be taxed on that $1,000 portion there.
Right.
And that's generally the threshold is $1,000 or more in unrelated business taxable income for
Uh-huh.
you to start being charged UBIT. Not an exact number; it's different for each person, but that's typically where it is.
Okay.
Now, so that would be a pass-through entity. You're investing in a business. The business is making money as a business, and it can't use your IRA as a tax-free avenue.
Right.
If it was
Right.
owned by all IRAs, now you have a business that doesn't have to pay taxes, and that's not quite fair.
Right.
So that's where that comes in.
That's Peter Thiel.
Now, yeah, yeah. Now the other side, debt financing, right? Let's say your IRA goes in and goes to buy, in this case, let's say a multifamily apartment building,
Okay.
right? And let's say to buy that apartment building, you get you put 60% down out of your IRA, 40% comes through financing for the
Okay.
apartment complex, right? There's private financing, everything there. So now you've taken this building that with your qualified funds, you
Hmm.
weren't able to purchase, right? You didn't have
Right.
enough. You only had 60%. So you had to use 40% of funds that aren't in a
Right.
qualified account.
Yeah.
So you're
Outside.
kind of mingling IRA retirement funds with
Mhm.
funds that aren't in. And now these retirement funds are benefiting from these funds that aren't retirement funds because they're
Right.
helping you get this building and turn it into a bigger multiple.
Right.
So that's where the IRS steps in and says, well, we should have been owed some money here.
Yeah.
And that's where the UBIT tax will come in. And essentially, you'll be taxed on the percentage that was financed,
Got it.
right? So if you have this apartment building, your 60% isn't going to get the UBIT tax, but that 40% you finance, you're going to pay a UBIT tax on that.
Got it.
So
Got
that
it. I see
is
that.
what UBIT is. And no matter how many times I talk about it, I still feel like I don't explain it well enough.
No, no, that was perfect.
Yeah.
Because typically, like you're saying, most of the people that we're going to be talking to are going to be investing with us at Bell Capital on the LP side. It's typically
Mhm.
going to be individuals. The LLC is already set up for them, but it is something out that some, like you said, people hear it, they're not sure what it is, so they'll ask. So I wanted to kind of address it a little bit, and you explained it perfectly. And then typically in that situation, I don't have a lot of people who have a business, or some type of retirement account or their own, like we call them a SEP or something. They've probably changed
Yeah.
1,000 times. To be able to invest through that to, to go from there. So, but this helps because that is a possibility for them and that they need to definitely check with their tax advisor to find that out. But we can
Yeah.
always find out for them too.
That's the best thing you could say on there is,
Yeah.
trust me, if you're worried about, does this investment have a UBIT tax? Am I going to have to pay UBIT out of my IRA? Is anything, talk to a tax professional. Like
Right.
that is the best place you can go to. Even if you have UBIT, like you have to pay a UBIT tax on there. Most times you have to wait for a specific tax form and they're not always ready on time.
Right.
Sometimes you have to plan it out with a tax professional to know how much you need to pay in advance. There's a
Mhm.
whole process to it. So please go talk to a tax professional if you're worried about UBIT. That's the best place you could turn to.
That's perfect. That's perfect. So thanks for that.
Mhm.
And this is one of the ones that because I go over this a lot with people. This is something I share with people to be aware of as an example of the retirement thing. So the mandatory 4%, and I'm sure it's probably rises up and down for people at what probably revenue bracket or income bracket they're in over time, right? But I always let them know, like, hey, at some point there's a mandatory withdrawal of 4%. And my explanation, and you can tell me whether this makes sense or explain it better. If you're, is it 72? Is that where it is now? 72 years
Yeah.
old?
So currently it's 73.
73. 73.
Is the current threshold right
Okay.
now. Now, some people may have hit that threshold, or when they weren't 73, as it changes throughout the years. But right
Right.
now, it's 73.
Okay. So what I explained to them is, and I'll stick to the 72 because I'm like, well, let's say you stay alive another 25 years and you have to take out a mandatory 4%. If that's possible, people may stay alive that long,
Mhm.
with technology and AI and health and stuff like that.
Who
If,
knows?
yeah, yeah, let's hope so, right? At the end of that time frame, typically, and I'm always seeing is like if you had to give away 4% for 25 years, that's 100% of your principal and it's gone depending on what's going on with your IRA account. The other version of that is if you invested money in multifamily and you're getting cash flow that's keeping up with inflation, paying you that way, at the end of that time when you hit that, you aren't giving away your principal anymore. Now you're contributing or your mandatory is coming from cash flow that went into your IRA and you still have your principal safe. Is that sound like a great explanation, or is there something within that 4% mandatory that I miss or some people may miss that may be valuable for that conversation?
No, that's you got a great kind of viewpoint and talk point on there of everything you're describing. I want to provide a little extra kind of
Yeah.
insight from our side too on that. So the 4%, right?
Mhm.
And I'm sure a lot of people have heard this, required minimum distributions,
Yeah.
RMDs. You'll hear the other phrase on there, 4% each year. That 4% is actually an estimation.
Mhm.
It's not an exact number that you can be like, okay, each year I know it's going to be exactly 4%. It's actually an estimation. It's recalculated every single year.
Wow.
Once you hit 73, it's recalculated every year. A lot of it is based off of your assets at the year end,
Yeah.
how much is in the account.
Yeah.
It's not like they take a snapshot when you're 73 and they're like, okay, they have $1 million at 73. So we get 40,000,
Yeah. 40 grand a year.
every year, no matter what, for 25 years. And then we have the whole million. It is recalculated based off your asset value. On the
Yeah.
flip side, if you're making a lot more, if once you're older than 73, you sell a couple investments and that amount skyrockets, they're
Yeah.
going to charge you more. That's
Wow.
part.
Yeah.
If it goes less, they'll charge you less. If it goes more, they'll charge you more. But
So you're almost
they
penalized for
do
making
evaluate
money.
it each year. Yeah, and with your custodian. So that part does change. So just be anticipated for that. The other thing is, especially as you're looking at self-directed IRAs
Mhm.
out there, a lot of these investments are illiquid,
Yes.
right?
Yeah.
And
There's
so
real estate
just
component.
as you described with multifamily, that cash flow coming in, like you said, whether
Mhm.
it's multifamily or another type of investment
Yeah.
structure, if you have your investments in real estate tied up, your money's tied up in equity,
Right.
right? You want to make sure you do have some sort of cash flow in to be able to account for that distribution.
Right.
So that way you're not having to sell off things to have the money to take out or anything like that.
Yeah.
But yeah, they're required by December 31st is when you need to take them by. I highly would recommend just kind of getting ahead of the game and looking into that before then,
Yeah.
because if you don't take your RMD by December 31st, you
Mhm.
will get one of those penalties or taxes we talked about earlier
Yeah.
from the IRS. And it could be up to 25% of the amount you're supposed to pull out. Right.
Wow.
So it could be a hefty tax. So definitely make sure you're staying on top of it if that's something you need to make sure you're taking out.
Right. Right. simple math, if it's 25% and you only had to do 4% consistent and you didn't, that accelerates 5 years of that. Jesus.
Yeah.
Wow. Yeah, so and that's why I tell people like sometimes it's just better to have your money in an illiquid asset that's cash flowing where you're passive, passive investing because our stuff is passive investing. They're looking for passive income.
Mhm.
And to be able to satisfy those things long term, because if you get into your retirement age, if you're like 40 or 50 or something like that, you're working or you have a business and you have your revenue coming in and you have a qualified plan, just roll your money in it. Let that thing keep stacking for you while you're of working age. And then when you can start to make choices, start to take choices as you start to move forward. So I think that's important, really.
Absolutely. And just to add on to that really quickly, if you have multiple IRAs, let's say you have a self-directed IRA, it's invested at Bell
Mhm.
Capital, and then
Yeah.
you have some funds in like a regular IRA invested
Yeah.
in the stock market, your RMDs, your required minimum distributions just need
Hmm.
to come from a culmination of all your IRAs.
Oh,
It's not
that's
like you need
good.
to take 4% from each one.
Right.
If
Right.
let's say your 4% comes out to $5,000, you have to pull out just a
Mhm.
random number I'm throwing out there.
Yeah.
It doesn't matter if you pull all 5,000 from one IRA or if you pull
Mhm.
2,500 from two IRAs or however you split that up, right?
Right.
As long as you take that distribution across your IRAs.
Got it. Got it. Man, that's perfect. Now, taking that distribution could raise your earned income status, right? Like because it's coming into you as
Could
earned income.
Yeah, could just depends on the structure you're set up with, traditional or Roth,
Okay.
right? If anyone doesn't know, traditional means that essentially you're taxed as you pull the money out, but you're not taxed as you put the money in.
Hmm. Hmm.
Right. And so as you're pulling the money out, and there are those taxes with it that could have some, implications onto your earned income or kind of how your taxes are filing that year.
Yeah.
Same way if you're contributing money to an IRA, it could
Mhm.
alter how your taxes are being filed. And on the Roth side, as well with its tax structure, ultimately, when you're taking these distributions, the best thing to do is, I'll always say this, I'll sound like a broken record,
No, it's
consult
good.
with your tax
Yeah.
specialist just to make sure you understand your exact scenario.
Absolutely. Absolutely. And we tell everybody the same. I think we share them like, hey, you have to consult with people. We don't know everything, but you have to get with your tax advisors, your consultants, your anybody that talks to you about this. And still, you need to make your own decisions. All investment
Mhm.
involves risk. And the biggest risk to me is always doing nothing.
Yeah,
So,
yeah.
yeah.
That's the one thing I always hear people like, "What's have started this sooner?" And
Yeah. Yeah. Exactly. Right. Everybody's regret. So, and the last thing I wanted to kind of go with this, yeah, like hold on one second. The last thing I wanted to kind of do on this one is how do they get started? Do they have a portal?
yeah, no, great question. So it's a pretty easy process to get started. The best thing you can do, especially if you're listening to this webinar here, is have a conversation with Bell Capital,
Hmm.
right? Have that initial conversation with them. Find out, if you're wanting to invest with Bell Capital, all that stuff that I know Victor's phenomenal at
Yeah.
talking to people about here. And after your conversation with Bell Capital, they'll start the process here with us. And here's how it's going to look like. We'll do a consultation call with you, just so we can make sure that we let you know what our account fees look like. We don't want you to be blindsided. We're very transparent with that information. So
Hmm.
we'll let you know what that looks like in our consult. If you haven't done an application, we'll help you get through that. It's just a quick couple-page application. Then you'll transfer the funds over from wherever they are, those Fidelities or Schwabs or wherever your 401k is, things
Yeah.
like that. You'll transfer those funds to us. That process, depending on the company you're transferring from, sometimes they like
Drag
to
their
hold on
heels.
to the money. They don't want to let it go, you
Yeah,
know?
drag their heels.
Exactly. It's like when you go to pay a bill, and
Yeah.
like you have to pay the
You're
bill,
like,
but like you
I'll
don't want to
do
see
it.
the money leave your account. And
Yeah. It's
it's
internal.
exactly like that. So
Yeah.
yeah, it's a little cat and mouse game for a little bit. That could take, I've seen that go as quickly as a couple of days. I've seen it
Okay.
take a week or two just to get funds transferred over. But as soon as funds are transferred, we're ready to go. We can fund your investment within 48 hours. I
Hmm.
know Victor here has some investment docs you'll sign on his end.
Right.
And then there is just a quick one-page form you sign on our end that says, "Hey, I want you to send my money to Bell Capital to invest."
Right.
Right. And then once that's done, your interest is going to go back to your IRA as soon as Bell Capital starts paying it out.
There we
Right.
go.
Whenever they pay out interest, it doesn't go to you. Make
Goes
sure
to
to
their
clarify
account.
that it goes to your
Yeah.
IRA. And you will have a client portal login.
Perfect.
Absolutely. You'll be
Yeah.
able to log in, see your account. You can see any investments that are currently being held inside of your account, your current available balance, as well as the full transaction history of funds that were leaving your account to be invested and funds that are coming in from you earning from your investment. You'll have a whole history of all of that.
Perfect. Perfect. And that was like the biggest thing for us is just to make sure like, hey, you will have a portal. Someone's going to walk you through this. You're not going to be walking blind. You'll have a professional on that side, and you'll have a professional with us as well. So I appreciate that.
Yeah,
So,
absolutely.
yeah, yeah, no, seriously, thanks for spending the time with us today. We're going to wrap this, but I really did this because I wanted to share this with people who have questions now and also people who may have questions in the future. So, Brock, thanks so much for doing this. We tend to tell people just go ahead and reach out to us at Bell Capital. Or if they wanted to reach out directly to you guys, how would they do that?
Yeah, so if you wanted to reach out directly to us, the Preferred Trust, the best thing you can do is go to our website,
Hmm.
www.preferredtrustcompany.com.
Hmm.
And directly from that website, you can schedule a consultation with us.
Perfect.
By all means, please do give us a call. We love that. But I would hate for you to call in and, hey, we don't answer the phone. We got to call you back. And now we're playing phone tag back and forth,
Yeah,
right?
yeah,
Versus you can just come in and let us know a time that's best to give you a call. I think that works best around. But even if you can't, just give us a call. We're very responsive, and chances are you're going to hear from us within the next few minutes, even if we don't answer.
perfect. 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 Well, I appreciate that. Thanks for spending time with us. And we're looking forward to helping people actually start to look at their qualified plans or qualified funds and start to convert with us. And any questions anybody would have, they can either ask me or definitely look forward to having them contact you guys. And we look forward to working with you guys and helping people be able to start this investment with us. So thanks so
Yeah,
much for taking the time with me, Brock.
thank you so much for having me here. We're super excited and happy to be working with you at Bell Capital, and I know there's going to be so much fun in the amount we're able to help our clients here. So thank you for having us on here.
Perfect. Perfect, man. Well, thanks so much, man. You have a great day today. Okay.
You too. Have a great day.
Okay. Bye bye.